The money sitting in your account isn't really there. That's not a metaphor, nor a conspiracy. If everyone tried to withdraw their cash tomorrow, the system would fall apart within hours, because the cash itself doesn't exist. And that isn't a glitch. It's the design. What we call banking was built on an elegant trick so old that it hides in plain sight, a trick that turns faith into finance. Economists call it fractional banking. It's the quiet machine behind debt, inflation, and the shimmering mirage of prosperity. Once you grasp it, you realize that money itself is a promise that can never quite be kept. To see how it began, we must travel back to a time before screens, before digits, before modern credit. In medieval Europe, wealth meant metal. Gold and silver were not symbols, they were money. The rich kept coins locked in chests, jewels wrapped in cloth, treasure heavy enough to slow a horse. But carrying wealth was dangerous. A road full of thieves made every journey a gamble. So the wealthy turned to goldsmiths, craftsmen who owned secure vaults. They left their coins in these vaults and received a simple slip of parchment, a receipt promising that whoever held it could reclaim the gold on demand. At first, these notes were mere convenience, but soon people discovered they could trade them directly. Why haul metal when a signed note carried the same claim? Paper began to move faster than gold. Then came the realization that changed everything. Goldsmiths noticed that hardly anyone came to collect their treasure at the same time. If 100 clients stored gold, perhaps one or two withdrew in a given week. The rest stayed untouched, gathering dust. So the goldsmiths grew bold. They began writing more receipts than the gold they held. If a vault contained 1,000 coins, they might issue 2,000 in paper claims. Those extra notes could be lent at interest. Profit from gold that didn't exist. As long as depositors didn't all demand repayment, the illusion held. Money had been conjured from thin air. What began as a convenience turned into revolution. The moment people accepted claims as good as gold, money creation slipped its leash. Physical reality no longer set the limit. From this sleight of hand, the first true banks emerged. By the late 17th century, even governments adopted the trick. The English crown, drowning in war debts, sought salvation in finance. In the year 1694, the Bank of England was born, not to serve the public, but to fund the state. It lent vast sums to the government, far more than it possessed in metal, in exchange for interest paid from future taxes. The empire's debt was repaid not with treasure from conquest, but with the labor of ordinary citizens. Sound familiar? It should. The same pattern rules modern economies. Governments borrow what doesn't exist, then tax the future to make it real. Across the Atlantic, early America copied the design. Banks issued notes promising redemption in gold, yet they too learned the power of overprinting. Whenever panic spread and depositors rushed to claim their savings, the illusion shattered. Bank runs swept towns. Fortunes vanished overnight. Each collapse revealed the truth that the money had never been there at all. And yet, instead of ending the deception, governments fortified it. They created central banks to stand behind the illusion, ensuring the crowd kept believing. If confidence faltered, the authorities would step in, refill the well, and assure the public that all was safe. Faith, not metal, became the foundation. Imagine walking into a bank today with $100. You assume it sits there waiting. In reality, only a sliver remains on reserve, perhaps $10 once upon a time. The other 90 are lent out to a business, a homeowner, a stranger buying groceries. That borrowed money finds its way into another account, where $9 stay and 81 are lent again. On and on the cycle turns. By the end, your original 100 has ballooned into nearly 1,000 circulating dollars. But only the first 10 exist as cash. The rest are promises stacked atop promises, debt wearing the mask of wealth. This is the heart of the illusion. Every new dollar begins its life as someone's obligation to repay with interest. And as long as those obligations keep expanding, the system seems to thrive. When they stop, the dream begins to tremble. For centuries, the fraction between gold and promise defined the rhythm of the world's economies. But in the 21st century, the ratio itself disappeared. In the spring of 2020, the Federal Reserve quietly reduced reserve requirements to zero. Banks no longer needed to keep even a single dollar for every deposit they claimed to hold. Money creation became a matter of keystrokes and confidence. If banks no longer need reserves, what restrains them? Not deposits, but regulation. Rules written far from public eyes, in a place called Basel, Switzerland. There, a committee of central bankers and technocrats known as the Basel Group set limits on capital and liquidity, determining how far banks may stretch the illusion. A bank that wishes to lend $100 for a risky project must now hold perhaps $8 of its own equity as a cushion. The rest may float on debt. It must also keep enough liquid assets, cash, bonds, instruments easily sold, to survive a storm. These constraints, complex and abstract, replaced the simple solidity of gold. Safety became a formula, but the deeper truth is stranger. Banks no longer lend from deposits at all. They lend first, and the act of lending creates the deposit. When you sign a mortgage, no vault opens. The bank simply types new money into existence. That entry becomes your loan, your obligation, your belief. Only afterward does the bank check whether its balance sheets meet Basel's equations. Over 90% of all money circulating today is this kind: bank-created, debt-born, intangible. The notes in your wallet, the digital balance on your screen, the number you trust, all echoes of that medieval trick. Goldsmiths once issued receipts for gold they didn't have. Now banks issue digits for cash that doesn't exist. And yet, the system persists because we continue to believe. We deposit, borrow, spend, and repay within a dream whose only anchor is confidence. When confidence holds, prosperity blooms. When it cracks, the world remembers what money really is: a promise waiting to be broken. The moment money was freed from metal, it became a story we all agreed to tell, a shared illusion reinforced by habit and hope. But every illusion has a cost. Ours is measured in inflation, debt, and power. Think about the chain that begins with a single loan. Each dollar created adds another promise to repay. That promise becomes someone's income, someone else's asset, and the system expands until belief wavers. Then everything that looks solid begins to dissolve. When a borrower defaults, the spell weakens. Confidence is the oxygen of this machine. Once it thins, panic spreads faster than reason. That's why every financial crisis feels sudden, even though the causes are ancient. The same rhythm repeats: expansion, euphoria, doubt, collapse. The first great warning came in the year 1929. Banks had lent far beyond their reserves, fueling a stock market that rose like a balloon. When prices turned, fear took over. People lined up to withdraw savings that no longer existed. Thousands of banks failed, fortunes evaporated, and the world learned, again, that faith can't be withdrawn on demand. It happened once more in the year 2008. This time, the gold wasn't in vaults, but in mortgages bundled into digital paper. Banks multiplied credit through derivatives and securities, building castles made of promises. When homeowners stopped paying, the structure imploded. Credit froze, markets crashed, and governments rushed in to save the illusion. They printed trillions, not in metal but in digits, to convince everyone that the system still worked. They didn't fix the trick. They fortified it. Because without it, the modern economy would simply stop breathing. Across the world, central banks became magicians of last resort. In the United States, in Europe, in the United Kingdom, in Canada and Australia, reserve requirements faded to nothing. Instead, the Basel rules became scripture. In China, India, and Brazil, regulators still demanded double-digit reserves, yet even there the Basel framework ruled from above. No matter the country, the real leash on money was no longer a pile of coins. It was a spreadsheet in Switzerland. Here lies the paradox. The system cannot survive if you are debt-free. If every household paid its loans tomorrow, the money supply would vanish overnight. Banks would have nothing to lend, governments no taxes to collect, businesses no cash to pay workers. The economy would freeze in place. Your debt is their lifeblood. That's why the cycle of borrowing never ends. Credit cards, mortgages, student loans, all are instruments that keep the machine humming. You are both the fuel and the collateral. Every swipe of a card extends the life of the illusion a little longer. Inflation is the side effect. Because banks keep multiplying the same dollars into more credit, each dollar's value the erodes. Prices rise not only from scarcity, but from dilution. The more promises circulate, the less each one is worth. Inflation is not a flaw, it's the design's pulse. You are asked to run faster just to stay still. Debt is the second consequence. Since every dollar is born as a loan, there is always more debt than money to repay it. Interest guarantees that the books never balance. Someone must always borrow anew. Or you want to refinance or default. That endless motion keeps the system alive until it doesn't. And then comes power. Banks earn interest on money they never truly possessed. Governments tap this invisible credit to fund wars, welfare, and bailouts without raising taxes. The wealthy who own assets that inflate with each new wave of money watch their fortunes grow. Meanwhile, wages lag, savings shrink, and ordinary workers chase prices that climb faster than paychecks. Every so often, the machine stumbles and the curtain lifts. The Great Depression showed it in black and white photographs, men in breadlines, bankers with empty safes. The crisis of 2008 replayed it in high definition. Both times, confidence broke, and the world remembered that numbers on paper are not the same as wealth. Yet each time, the remedy was the same: print, patch, and proceed. Officials promised reform, then quietly built taller walls around the same foundation. Because the alternative, admitting that money is mostly belief, was unthinkable. Look closely and you'll see the pattern in miniature. When a bank grants a mortgage, it doesn't hand you someone else's savings. It creates new money by typing numbers into existence. Your signature births currency. Your monthly payment keeps it alive. If you default, that money dies. If you borrow again, it's reborn. This cycle is the bloodstream of modern finance. By now, more than 9 out of every $10 in circulation are digital echoes. Bank money, not central bank money. Only a tiny fraction exists as physical, cash, or reserves. The rest lives inside databases, backed by confidence and enforced by law. That design links us back to the goldsmiths of medieval Europe. They issued more receipts than gold. Today's bankers issue more credit than cash. The scale has changed, but the principle has not. The danger hasn't either. When trust falters, no law can make numbers add up to reality. So what does all this mean for you? First, understand that money is not wealth. Real wealth lives in land, resources, skills, knowledge, things that survive when paper dissolves. Second, debt is not neutral. It binds you to a system built to serve lenders and governments first. Third, inflation is not random. It is the price of belief itself. None of this demands despair. It demands awareness. Saving cash in a bank will not protect you. The digits are not yours until they are withdrawn, and even then they melt in value each year. Building real assets, cultivating independence, and reducing reliance on credit are the quiet forms of resistance left to ordinary people. History doesn't repeat, but it rhymes with eerie precision. The goldsmith's trick, the bank runs of the 19th century, the bubbles of the 21st, all verses of the same refrain. Promises multiplied beyond reality, and a public eager to believe until belief runs out. Every major financial crisis has whispered the same truth. Stability rests not on gold or productivity, but on confidence. And confidence is the easiest thing to lose. When it goes, the numbers in our accounts become what they always were: digital reflections of a story we agreed to tell. So the next time you check your balance, remember most of it exists only as code, born from a system that was never built with your freedom in mind. Understand the trick, and you step outside it. Ignore it, and you remain a player in a game where the house always wins. History still murmurs its warning, soft, steady, and clear. Money is faith, not fact. And faith, once broken, does not mend easily.